Joel Greenblatt's The Little Book That Beats the Market promised something almost dangerous. Beat Wall Street using nothing but two simple numbers. No PhD, no insider information, just math. And for years it actually worked. But this is 2026. Markets are now dominated by AI trading bots executing millions of trades per second. Hedge funds mine satellite data, social sentiment, and cloud activity before retail investors even wake up. So today, we're putting Greenblatt's legendary magic formula through a modern data mining meat grinder. Can a 20-year-old value investing strategy still survive in today's brutal high-frequency landscape, or has modern finance finally exposed the fatal flaw behind the magic? When The Little Book That Beats the Market was released, it felt revolutionary. Joel Greenblatt simplified investing into two metrics: earnings yield and return on capital. That's it. The strategy ranked companies that were cheap compared to earnings and extremely efficient at generating profits, and historically the results crushed the market. For ordinary investors, this felt like discovering a cheat code because before this book, investing seemed locked behind Wall Street jargon and billion-dollar analysts. Greenblatt made it sound simple enough for anyone with a spreadsheet, and that simplicity became the entire appeal. But here's the uncomfortable truth. The magic formula was born in a completely different market era. Back then, information moved slower, retail investors had fewer tools, institutional algorithms were primitive, and markets were far less efficient. Today, AI systems scan earnings reports in milliseconds. Entire hedge funds are built around exploiting tiny inefficiencies before humans even notice them. So the real question becomes, can a strategy designed for an industrial era stock market still generate alpha in a world dominated by machine learning and quantum scale computing power? Because if everyone already knows the formula, is there any magic left? To test this, researchers and quantitative investors began running Greenblatt's strategy through modern backtesting systems, not simple spreadsheets but high-frequency simulations, post-pandemic volatility data, AI-enhanced factor analysis, and market conditions that include meme stocks, flash crashes, and algorithmic panic cycles. And the results became complicated. The original magic formula still worked in certain periods, but its consistency weakened dramatically. Why? Because modern market changed what value actually means. In Greenblatt's era, valuable companies owned factories, equipment, inventory, and physical assets. But modern giants like cloud companies and AI firms derive value from software, intellectual property, network effects, and data infrastructure. Traditional return on capital metrics often fail to capture these intangible assets correctly, and that creates a massive problem. Some companies appear cheap according to the formula, but they're actually dying businesses trapped in permanent decline. This is what modern investors call a value trap. A low PE ratio no longer automatically signals opportunity. Sometimes it signals shrinking relevance, collapsing innovation, or industries being replaced entirely. In other words, the market evolved faster than the formula. Now things get interesting. Researchers started comparing Greenblatt's original system against modern neural network factor models, and honestly, the comparison was brutal. The AI systems adapted dynamically by shifting sector exposure, adjusting for macro trends, filtering sentiment volatility, and identifying hidden risk clusters in real time, while the original magic formula remained static, rigid, and unchanging. In sectors like biotech, semiconductors, and high-burn AI startups, the formula often completely broke down because these industries prioritize future dominance over present profitability. A company burning billions today might become the next trillion-dollar platform tomorrow. The original magic formula interprets that as weakness, while modern algorithms interpret it as optionality. And there's another hidden issue most retail investors never notice: slippage. In Greenblatt's day, trades executed relatively cleanly. Today, high-frequency firms front-run predictable behavior patterns, meaning slow-moving value strategies can quietly lose performance through execution delays, bid-ask spread widening, and liquidity distortion. Tiny inefficiencies compound over time, and suddenly the market-beating edge disappears, not because the idea was wrong, but because the environment changed. But here's the surprising part: the magic formula isn't completely dead. It just needed an upgrade. Think of this as Magic Formula 2.0. Modern investors began patching the original strategy using updated filters. Instead of relying purely on earnings yield and return on capital, they added free cash flow yield, R&D efficiency, debt-adjusted profitability metrics, and revenue durability scoring. Why does this matter? Because modern tech giants carry enormous debt loads while simultaneously investing heavily into future growth. Traditional accounting often punishes companies making aggressive innovation bets, but modernized factor models recognize the difference between productive investment and financial decay. This updated framework also filters out zombie companies, businesses that appear statistically cheap but survive only through debt refinancing and declining relevance. The original formula accidentally recommends many of them, while the updated version aggressively removes them. And interestingly, once these modern filters are applied, value investing starts working again. Not perfectly, but far better than critics expected, which reveals something important. The core philosophy wasn't broken, the measurement system was outdated. So how would someone actually apply this today? Modern investors no longer build these screens manually. They use quantitative scanners, financial APIs, automated factor dashboards, and machine learning enhanced filtering systems. The workflow now looks something like this. First, screen companies for high free cash flow yield. Second, filter out firms with deteriorating revenue trends. Third, adjust profitability metrics for debt and R&D intensity. Fourth, eliminate weak balance sheets and zombie businesses. Fifth, diversify across sectors to avoid concentration risk. And most importantly, risk management becomes everything because modern markets are vulnerable to flash crashes, AI-driven volatility, social sentiment attacks, and liquidity cascades. A great company can still drop 25% overnight because of algorithmic panic. That's the new reality, which means value investing today is no longer about finding cheap stocks. It's about identifying durable systems the market is temporarily mispricing. That's a huge difference. So does the little book that beats the market still work? Yes, but not in the way most people think. The original formula alone is no longer enough to dominate modern markets consistently. The financial battlefield evolved, algorithms became faster, markets became smarter, and accounting itself became less capable of measuring intangible value. But the deeper principle behind Greenblatt's philosophy still survives: buy exceptional businesses at irrational prices. That idea never died. What changed is the lens required to see those opportunities clearly. In 2026, value investing isn't obsolete. It's simply become high definition, and the investors who adapt may still discover something Wall Street desperately wants you to believe no longer exists: an edge. If you enjoyed this breakdown, subscribe to Earning Per Page for more finance books decoded in under 10 minutes and comment below. Do you think traditional value investing is still alive, or have algorithms permanently changed the game?